Monday Markets, FTX app, best mobile trading app and tracking experience on the market. Get it to support us. You can also do so by liking the stream, subscribing to the channel, doing all that good stuff. Now, let's go through this fairly quickly because I'm sure there's a lot of nonsense to scroll through, watch, etc. Two things relevant. I'm not going to do the whole if it reclaims 35, 37, yada yada. You've heard it before, you know exactly what it means. That's not where we are right now. What matters now, two structures. One is if the market turbo nukes and we're fucked, 12 to 14k, previous cycles levels, monthly support, have that on your radar. We do have some stuff in front of us, specifically the 200-week moving average here at around 22k. Why is this level important? It's a medium-term trend proxy that has been useful in gauging where previous bear markets have bottomed out. It happened on the 6k breakdown in 2018. The market retested the 200-week, spent some time consolidating there, and then eventually emerged a new trend. Granted, it was fairly short-lived, but on a percentage basis increase, that's pretty good. And it also is where this crazy nuke bottomed out, so still relevant for a trend measuring tool. And the same with the COVID crash. Although it got violated quite a bit by the massive liquidations that took place, more or less, eye test-wise, that's where the market stabilized and eventually started the uptrend we enjoyed oh so dearly over the last couple of years. So just looking at that now, we are reaching the equivalent 200-week moving average at around 22k or thereabouts. Now, in terms of, is this the bottom? I think two considerations come first. The first is that it's very likely that the market is going to spend anywhere from 1 to 5, 1 to 4, 1 to 5 weeks consolidating in this area, even if it is the bottom. So trying to buy it on a first-time basis isn't necessary. You may choose to do so, but it's not necessary. The second point, which follows on from the first point, is that if we look at the most recent piece of evidence we have, even though on the closing basis, the 200-week moving average was helpful in establishing the bottom, the difference between the level itself and how low price actually went, I'm pretty sure there's like 30-40% volatility on these moves, right? So you might think, oh, well, we're at the 200-week and I better buy it because that's support. The last time participants did that, they had to face a 30% drawdown before the market sort of stabilized. And that would take price to much closer towards monthly support. And in general, it's not super comfortable, like buying a do or die level and then having to be 30% underwater. So what conclusions does that lead us to? One, there's nothing wrong with waiting. Like, there's enough evidence to suggest price will sort of stick to this level, even if it is the bottom. So if you want to wait for a weekly close or a failed weekly breakdown or something like that, that's completely reasonable. The second point is, on both occasions, the 200-week moving average is very rarely tick perfect, and that's expected given it's a high time frame level. So if you are buying the first test of the 200-week moving average, try to get it as a discount, which is to say that some sort of wick through it or a 10, 20, 30% move through it is on average going to be a better setup than blindly leaving a limit order at the level itself with no other expectations, at least in my view. Again, the sample size we're dealing with here isn't great at all. It's basically 2, and the macro is completely different and all this other stuff. So this support structure comes with some caveats. For me personally, I'm comfortable making the argument of waiting for at least 1 to 2 weeks to see whether the market gives a shit around here or forms some sort of clearer failed setup. That's my view. If you do want to buy it first time, be my guest, but I think discounts in that case are preferred. That's really the only relevant thing as far as market commentary right now. If you look at where we are on the daily time frame, it's a rather straightforward setup, which is to say we had to move down, we consolidated for a month, and we had to move down. Again, classic sort of downtrend price action. If you want to be bullish or constructive, at least on this time frame, for once we need one of the range breakdowns to fail or at least be reclaimed, which is to say back above 28, there may be a range trade available towards the highs or even a deeper push. But until any type of time frame range is reclaimed, you just have to assume it's downtrend continuation. So TLDR, monthly support 12 to 14k still. Weekly support, we're more or less there now in the form of the 200-week moving average. But in my view, if you're going to be trading this type of structure, the better trades are either on some sort of big discount relative to the level, where then you get to play a kind of a snapback trade and you're fishing for the higher time frame weekly wick if it is happening, or the better setup is basically just waiting 1 to 2 weeks for the market to do stuff around that 200-week moving average, and then based on weekly closing candles, even if you're not catching the Pico bottom, you'll have a much clearer signal to trade with at that point. That's my view on BTC USD. ETHUSD, no different really. Monthly time frame, well, we're below a kind of prior cycle all-time high, which is insane to think about, but not relevant for present purposes. Where are the monthly structures? One of them is the highest close of the previous cycle at around 1.1k. And then if that doesn't hold, we have to deal with the bear market cluster range between 400 and 800 roughly. Let's actually draw those as levels very briefly. Lowest close before the bear market nuke, highest close before the bear market nuke. Those are your higher time frame structures. As you can tell on ETH, the 200-week moving average is there already. And more or less the same considerations apply. I think if you're going to be trading the first test of the 200-week moving average, if you can get it at a discount, that's better than buying it outrightly, especially if you get a move kind of like below 1,000, for example, in which case you'd be discounted relative to the 200-weekly moving average. You're at monthly support, and you also get to wash out those round number panic sellers. That would be really nice, but not guaranteed. But same two rules apply. One, if you're trading it first time, a discount is usually better than trading it outrightly. Two, it's very likely that even if this is the bottom at the 200-week moving average, the market's going to spend anywhere from 1 to 4 weekly closes around that area, so there's no need to rush. And there is a third one, but it's escaping me at the moment. So let's stick to those two for the time being. And the third, I've remembered, the sample size we're dealing with when it comes to these 200-week moving averages isn't particularly high, and so that should be reflected in your conviction and sizing as well. Nothing further really to add on the daily time frame. Same old thing. We have high time frame breakdown. If that gets reclaimed, maybe you can be constructive, but none of this stuff has been reclaimed yet. Worth keeping an eye on, but not a ton of evidence that it's forming. That's really it. As far as macro stuff, I know that people want me to talk about like Celsius and whatever else, but I'm sure I wouldn't have anything to offer that you haven't read already. And go listen to the weekly open show that I co-host with Legistatus and Donald, where we talked about that type of stuff in a bit more detail, but it's not entirely relevant for this video. Especially given, look at legacy markets, right? You can point a finger at Celsius and say, oh, Celsius bad and it's Celsius's fault and crypto systemic risk spillover and so on and so forth. But this is what traditional markets look like, right? TradFi looks like shit right now, breaking its lows. So Celsius or no Celsius, there's a really high likelihood that we would have just dumped on top of it. Maybe we're dumping harder or more reflexively because of those crypto-specific supply pressures created by Celsius, Terra Luna, all these other lending services and all the stuff going on under the hood, sure, but it doesn't really change the higher time frame big picture. And as far as equities go, it's not entirely clear to me that they've reached some sort of bottom or that they look particularly constructive. Maybe if I think there's FOMC this week as well. Maybe again, if we get some sort of failed breakdown type of structure, or if we reach monthly support. I think S&P is slowly getting there, although the first reaction hasn't been great. You can kind of just see with this monthly cluster, it's reaching that type of area, but there's not a whole lot going on. And the NASDAQ as well puked through its monthly cluster range high, so the next target is the monthly cluster range low at the very least. But TLDR, crypto looks bad. Yes, there are, it looks bad because of crypto specific kind of supply overhang issues created by Luna, Celsius, and all the other stuff that comes under the hood. But it's not a crypto specific issue. It's just like a global tightening liquidity crisis. Stuff is breaking all over the place. So just kind of blaming Celsius on its own doesn't make a ton of sense. Everything looks kind of rough. Risk is getting hammered. We are part of the risk basket until proven otherwise, and we just have to live and deal with those consequences. I'm going to stop rambling. Hope that was helpful. Focus is pretty much on the 200-week moving averages and see if they generate any decent bounce signals over the next 1 to 3 weeks. I would say in these conditions, kind of watch your trading size. 1K moves at 50K are not the same as 1K moves at 20K. So make sure you're not getting caught out by that. And keep an eye out for the Technical Roundup newsletter tomorrow, trletter.com, where I'm sure I will argue these things with Don slightly more eloquently and with more detail. I just wanted to kind of get this out to update you on what the kind of stuff I'm focusing on. That's all from me. As always, thank you to FTX app for supporting the show. Track your portfolio, hide your portfolio, or do all that useful stuff. That's all from me, and I will see you on Friday at least, but tomorrow for the newsletter. Take care. Goodbye.